All right, let's talk UAE VAT. Today, we're going to open up the compliance playbook and break down the absolute must-know administrative rules for any business operating here, from record keeping all the way to filing your returns. So here's the game plan for today. We've got 4 main parts we're going to tackle. We'll start by building the foundation with record keeping, then get into the key plays around tax invoices. After that, we'll cover the end game, filing your return, and wrap up with some special cases you definitely want to know about. All right, first things first, we've got to build a solid foundation, right? And when it comes to VAT, that foundation is all about your records. If you get this part right, honestly, everything that follows becomes so much easier. Okay, take a look at this list. The first thing you'll probably notice is, wow, that's a lot of paperwork. And the law is super specific here. It's not just about the invoices you're sending out or receiving. It's everything: imports, credit notes, even tracking when you didn't claim back VAT. Think of this as your complete financial story, ready to go. So you've got all this paperwork. How long do you actually have to keep it? Well, the magic number you need to remember is 5. For most of your standard business records, you need to hold on to them for a minimum of 5 years after the tax period they belong to is over. And you know, that 5-year rule isn't just some random number they pulled out of a hat. There's a really good reason for it. It's all about giving the Federal Tax Authority, or the FTA, enough time to come in and do a tax audit if they need to. It's all about having a clear, verifiable trail. But, and you really got to pay attention here, that 5-year rule isn't set in stone. There are some major exceptions. I mean, look at this. If you're in real estate, we're talking a massive 15 years. And if you get audited or need to make a late disclosure, that timeline gets extended even further. Okay, so we've got our records sorted. That's our foundation. Now let's move on to the next big play in our book: mastering the tax invoice. This is probably the document you'll be dealing with day in and day out. Think of a perfect tax invoice, like following a recipe. You can't just leave out an ingredient and expect it to work. Every single one of these points is crucial, from literally writing tax invoice at the top to having all the right names, addresses, and especially those tax registration numbers, or TRNs. And speaking of timing, you're on the clock. Once you make that sale or provide that service, you have exactly 14 days to get that compliant tax invoice out the door. Not 15, not 16, 14. It's a hard deadline, so you can't let it slip. So, after seeing that long checklist, you're probably thinking, do I really have to do all of that for every single invoice? It's a fair question, right? Especially if you're running a busy shop. And the good news is, no, you don't. The rules are actually pretty practical here. They allow for something called a simplified tax invoice. This is a total lifesaver if your customer isn't registered for that, or if the wholesale is under 10,000 dirhams. It cuts down the paperwork quite a bit. Okay, so you've kept your records, you've mastered your invoices. Now for the end game, pulling everything together and filing that VAT return. This is where all that diligent work really comes together. So when it comes to filing, there's one question that trumps all others. When is it actually due? Getting this deadline right is, well, it's absolutely non-negotiable. This is the date you can't miss. The number you need to burn into your brain is 28. Just 28. That's your key date for the entire VAT cycle. So what does that mean? It means you have to submit your return and pay any tax you owe by the 28th of the month that follows the end of your tax period. It's a consistent rhythm. Your quarter ends and your deadline is the 28th of the very next month. Let's make this super clear with a quick example. Imagine a company. We'll call them JJ LLC. Their tax quarter ends on March 31st. So when's their deadline? You got it, April 28th. Simple as that. It's the same pattern every time. All right, last section. Let's talk about the special teams. These are the unique situations and exceptions that might not hit every business, but if they apply to you, you absolutely need to know these rules. If you're in the e-commerce space, this number should definitely grab your attention. 100 million AED. If your taxable supplies through online channels cross that mark in a year, you trigger a whole different set of reporting rules. It's a big deal. Now, this is a really interesting one. Are you acting as an agent? Because it matters a lot. If you're a disclosed agent, where everyone knows you're acting for someone else, the principal handles the VAT. But if you're an undisclosed agent, acting in your own name, the law sees you as the supplier, and the responsibility for that tax invoice lands right in your lap. Okay, but what happens when something goes wrong after you've already sent an invoice? You know, a customer cancels an order, returns something, or you realize you made a mistake. That's what the tax credit note is for. And just like an invoice, there's a deadline. You've got 14 days to issue it. At the end of the day, all of this, all these rules, it comes down to this one simple fact, straight from the law itself. The federal tax authority is in charge. They administer, they collect, and they enforce. Compliance isn't a suggestion. It's just how business is done here. So there you have it. We've gone through the entire playbook, from the foundational records to the final return. But having the playbook is one thing, actually using it is another. So the real question to ask yourself is this. Looking at your own business right now, which one of these plays do you need to review and tighten up today?